Welcome to Blue Chip Now, the podcast that gives you insider access to content that we tailor specifically for our clients. Whether you're climbing the corporate ladder or just seeking smart, efficient intel, we've got the answers to your most pressing financial questions. Join us as we break down the markets, debunk the headlines, and keep you ahead of the curve. Let's dive in.
Welcome back to another edition of the Blue Chip Partners Quarterly Edge. You're here with Daniel Dusina, and I'm joined by Dan Seder, so we can walk through our outlook for the upcoming quarter and beyond. Dan, thanks for joining me once more.
Thanks for having me, Daniel. It's going to be a lot of fun.
Agreed.
All right. Well, let's kick off with the economy. So the economy isn't as rosy today as it was at the end of 2024. So what's going on? What are you seeing in the data?
Yeah, well, the information that has been brought to the forefront since the end of last year with regards to tariffs and other political activity, the crux of it is there is so much uncertainty that it's really hard to either get really optimistic or really pessimistic. So if you'll recall, coming into this year, I was really optimistic on the consumer. Good balance sheets, good earnings growth. I thought that would afford consumers with a high level of ability to spend in a discretionary manner. I'm not going to sit here and say that has changed materially at this point, but it is just too early to tell. So I will walk through in very simple detail what has changed, what has not changed, and what I think we should focus on for the next few months.
Great.
Start with the labor market. Realistically, the picture has not changed materially. Unemployment rate, we're at 4.1%, a small uptick from the 4% roughly that was seen at the end of last year, and well below the long-term average, recall. Job additions, new jobs added month to month, we've seen a little bit of a downtick, but let's just call out the fact that the 3-month moving average of 200,000 jobs added a month, that's new jobs in the U.S. economy, is greater than the average for all of 2024. Wage gains, what are people getting paid? That continues to outpace the overall level of headline inflation. These are all good signs that individuals from an employment perspective are not deteriorating rapidly.
And that being said, they should be able to spend. So they're working, people are working, more jobs are being added, and people are getting paid more. So they should be able to afford elevated inflationary costs or costs of living.
Right, and I would call it back to the fact that what we called out at the beginning of this year is that individuals' balance sheets are just on really good footing because of 2 strong calendar years in the market.
Yeah.
So even though you have this elevated level of uncertainty and the data hasn't been overwhelmingly good to start the year, I think you have a lot more wiggle room now than you have in past periods.
And just to be clear, that's called the wealth effect. So as portfolio values increase, people feel wealthier, and because they feel wealthier, they're more inclined to spend.
Yeah, and usually that is true. That is the wealth effect. Yeah. What's been different, at least in my opinion, through the first quarter of 2025, is that because there have been all of these changes to the political conjecture, and it's so publicized, I think that is showing up in spending figures.
Sure.
Retail spending to start the year has been a little choppier.
Yeah.
So the willingness to spend hasn't been there. That has no impact on the ability of consumers to spend.
Sure, and I think you're relating back to the tariffs and what the impact is of the uncertainty of the tariffs. And of course, that's going to create a cloud of questions that the labor market, labor market moves a lot slower. The data comes out more gradually. So we're able to react to these where tariffs are just thrown in our face, and we're wondering, what does this mean? How long is it going to last? What's the impact?
Yeah, and like I said at the onset, it is just too early to tell.
Too early to tell.
I'm not going to panic because it's too early for that as well.
Right.
But we're certainly going to be watching the data very closely because there's a very direct impact on the U.S. economy.
Yeah.
Right?
Yep.
The last thing I did want to call out, because we do get questions on debt all the time, specifically the fact that we've seen rising credit card utilization, we've seen overall debt at the individual level start to creep up. Yeah. And while that is true, I would say 2 things. That debt ticking up is all relative. So if you look back towards 2020 and 2021, right at the onset and then immediately thereafter the pandemic, household balance sheets were in such good shape that, their debt was not really needed to be leaned on. When I look at debt, I think you have to look at it relative to something else, right?
Sure.
In a standalone basis, just because someone has leverage, that doesn't really tell you anything. So if I look at the level of debt on average across U.S. households, I like to compare that to disposable personal income. So how much debt relative to what they can actually spend? Like, what does that figure look like? And to me, that's the chart on the bottom right-hand side of this screen. To me, we're still below what the kind of pre-pandemic trend was. So even though you might see publicized headlines around debt creeping up, debt utilization and credit utilization creeping up, number one, that can be taken as a good thing because that flows through as spending in the economy. But the whole other side of it is relative to what? Relative to personal income and disposable income, debt does not look anywhere even close to an area that would flag kind of in red to me.
Sure. So you have spending. You have we're watching the labor market to understand its effect on spending. We're watching debt, personal debt, household debt. You relate it back to spending. These are all great data points to understand what's happening in the economy. How are consumers driving businesses here in the U.S. economy?
Yeah.
Fantastic.
So, tagline is, it's way too early to celebrate, but it's far too early to panic.
Okay. Outstanding. Let's transition on to the stock market, equities. The market has been a lot more volatile in the first quarter. So we came out of 2024 with a jump in stocks. The market peaked somewhere around mid-February. I believe it was February 19th. And then we've seen a pullback since. But year to date, if we look at where the stock market started at the beginning of the quarter and where it is today, we're really close to all-time highs in stocks. So while we've seen a lot of volatility, we really haven't pulled back maybe as much or as severely as the media and the rockiness of the market might lead individual investors to believe. So tell us a little bit about what's happening in stocks.
Yeah, and contrary to what the media would publicize or has publicized, the S&P 500 cap-weighted index is only down about 1.5% this year, as of this recording at least.
Yeah.
So number one.
And that's, I think, reflected from the volatility, because at one point the index reached correction territory, which is 10%. Again, who determines that a number like 10% is a quote-unquote a correction? It's meaningless, but the media can hang their hat on it. So there was a pullback and the market has bounced back. So it's the volatility that I think people are concerned about, not the overall levels.
Right. And so even within that, though, I don't want investors or individuals that are watching this to come away with an extreme level of fear, because the first quarter of returns in the equity market in the U.S. were negative. So even though that's likely to be true, I mean, all headline indexes are tracking negative in the equity market for the U.S. for the first quarter of this year. But the silver lining to me is that we're about to see something that will only be the third occurrence of such in the last 2+ calendar years. And that's exactly what I'm showing on this screen. I'm showing that over 50% of S&P 500 constituents will likely have outperformed the headline index return for the first quarter of this year. Why is that important? Why is it only the third time that this has happened on a quarterly basis going back to 2023? Because the market has been so dominated and so concentrated over the last 2 calendar years that it's all been driven by just a few firms and really just a few sectors. So it's not all doom and gloom when we look at the first quarter, even if headline indexes print a negative number. That doesn't imply that you had every single company in the S&P 500 print a negative return for the first quarter. Quite the opposite, actually. Yeah. You had over half of companies that outpaced the headline index, which to me, I've talked about this in the past in terms of broadening of returns. I think that does signal a healthy market. And the fact that investors now have more options than just having to pile into a few specific names to generate any semblance of return, I think that's a good thing. And it should serve as a reminder in terms of investors addressing or assessing their level of concentration, because the next 5 years, more likely than not, are not going to look like 2023 and 2024, when it was just a handful of names and a handful of sectors that drove all of the market's performance.
Yeah. I think but the analogy that I use is you have the stock market and then you have a market of stocks. And if you look at the market of stocks, more than half outperformed the aggregate. More than half of those stocks outperformed the market of stocks. The stock market, and when you refer to the headline index number, meaning the number that is reported on the S&P 500 by the media, even though that's negative, more than half or a majority of the companies outperform that negative number. So that's really, really good data.
Yeah.
Anything else in stocks?
Well, I mean, so that kind of, I would say that's the high level stuff.
Okay.
But, and even though we're not tactical in terms of trading and trying to time the market, another really interesting observation is looking at investor sentiment. And we've covered investor sentiment many times in the past in this forum, in other forums with regards to outward-facing media, blue chip. But I do really think, especially right now, it's an important consideration and it's important to call out, especially keeping in mind that 10% correction that is likely staring people in the face, the negative return that's likely going to be printed for the first quarter. That's made investors at the individual level fairly pessimistic. So looking at things like the American Association for Individual Investors Investor Sentiment Survey, which has data released each week and basically shows the level of optimism or pessimism that exists across the retail investor base in the U.S., it can have a really, really interesting impact, or I shouldn't say impact, but it can act as a really interesting precursor or a useful indicator for investors in terms of forward returns.
And that's a contrarian indicator, right?
It is, meaning when investors at the retail level are incredibly optimistic, that has historically preceded a period of below average returns. And the exact opposite is true when investors are overwhelmingly bearish. That's generally preceded a period of attractive returns, at least historically speaking.
Yeah.
So what I'm showing on the screen right now, I just want you to focus on where we are at today. So all the way on the right-hand side of this chart, you'll see the blue line down at the bottom, and that blue line is showing you the percentage of respondents to this AAII Investor Sentiment Survey that are bearish relative to those respondents that are bullish. So when you get this line creeping down below 35%, negative 35%, meaning the bears outweigh the bulls by at least 35%, we think this indicator can be really useful at extremes, and we've pegged 35% in either direction as an extreme. And this is very rare that it actually gets to those levels, right?
Yeah.
But when you get below that green line, which is at 35% on the negative fashion, bears outweighing bulls, the forward returns is really interesting. They're really interesting, I should say. What do I actually mean? Well, the long-term average of the S&P 500 index is, roughly 10%, right? Specifically, given the period I looked at, which dates back to about 1990, the long-term average there is about 10.7% for the S&P 500 index. So in this table, I just want you to look at that top portion that pertains to the S&P, which shows you that after the AAII Investor Sentiment Survey indicates that individuals are extremely bearish, meaning bears outweigh bulls by 35%, the forward one-year return for the S&P after those periods on average is 19.5%. versus that long-term average of 10.7%.
So what a testament to being a long-term investor, because as markets drop and sentiment deteriorates, a lot of times that's when we'll get a call from a client and they'll ask, should I get out of the market, or should I be moving to bonds, or should I be more conservative? The fact of the matter is that's almost the time to put your foot on the gas. I mean, not that you necessarily take action, but the reason you want to be a long-term investor and not hop lines at the grocery store is because when things get washed out from a sentiment perspective this badly, that's often when you get the best forward-looking returns.
Right. Yeah, and look, I do recognize that there is still a whole host of uncertainty out there. Corporate earnings through the first quarter that looked at the fourth quarter results were somewhat mixed, but at the end of the day, the message to you guys, to investors and individuals, is that we have good companies that are on sale, and using history as a guide as it pertains to sentiment, I'm interested at these levels.
Fantastic. Really, really good. Okay, let's transition into bonds. The stock market, as we just mentioned, we saw a lot of volatility. Bonds actually did their job. They've been the laggard for the last 10 years and have really probably disappointed overall portfolio performance. But this past quarter has been a different story. Tell us about what you're seeing in the bond market.
Yeah, I mean, it's a welcome thing to see. I think investors in general are still scarred by what happened in 2022, in which bonds certainly did not protect from equity declines.
But bonds down double digits in 2022.
Right, yeah, which served to deteriorate long-term returns.
Right.
So I think that has somewhat foreshadowed a very large preference for something like money market funds, where you're clipping a very reliable coupon, a coupon that is elevated relative to the last 15 years, keep in mind.
Yep.
But what I would say is that bonds did their job, and the value proposition, in my opinion, is still very good. So top piece of this slide is just showing you the year-to-date returns for the Bloomberg U.S. Aggregate Bond Index and the individual sector components of that index. What I want to focus on isn't necessarily, calling out munis or calling out securitized as a pound the table type buy. It's really not that. It's just that I think that a diversified bond portfolio, for those who have a strategic and need a strategic allocation to the bond market, is still in a really good spot right now. We've talked about in the past how the current yield, it can correlate very highly with your long-term return in that asset class.
Meaning what you're getting paid from bonds in income can correlate to the long-term total return?
Yeah, so to have the bond market in the U.S. at 4.5%, 5%, yield to worst right now, I think that's still a really strong proposition. And keep in mind, I really don't care whether or not the interest rate environment changes materially over the next 9 months. There are still very broad expectations for the Fed to cut rates. I'm not saying the bond as an asset class are attractive because I'm banking on that. I think their value proposition exists regardless of them, because I'm of the opinion that you will likely continue to see equity volatility. It's just the nature of the reality right now.
Yeah.
Information is coming out almost on a daily basis right now that is shocking markets, whether that's reciprocal tariffs that are slated to go into effect, kicking the can down the road on certain tariffs against certain countries. The information flow has been so rapid and ever-changing that it's just not going to surprise me if we get continued volatility in the equity market. And so with that in mind, I do think that for folks who it makes sense to have a strategic allocation to bonds, you should just make sure that you're making the most of it, right?
Yeah.
Especially if interest rates do start to decline.
Yeah, I think it's an entirely different story in an environment like today relative to the past, call it 5 to 10 years, depending on the environment, when rates were so low. Now with an elevated interest rate environment, investors are getting paid in the bond market, and that makes all the difference. So, I mean, that's really, really powerful.
Yeah.
Awesome. Anything else in bonds that we should cover? Did we hit all the talking points?
I think that hits everything. And again, like the tagline is just that it's too early to celebrate any of the economic wins that we've seen, and it's far too early to panic and really lose sleep over what the underlying impact of some of the political actions are going to be. You're still seeing pockets of value and opportunity in the equity market, and the bond market is giving you a unique opportunity to, what I would say, is lock in an attractive level of coupon.
Outstanding. Daniel, thank you so much for your insight. Really, really valuable.
And thanks as always for joining me, Dan.
Awesome.
It's always appreciated.
Thank you.